Good morning, everyone. Welcome back to Morning Markets. Thank you to those that subscribed on the channel yesterday on YouTube and to those comments that were posted. They're very much appreciated. And please do that today if you find the podcast useful. Then turning to markets, yesterday we touched on that Chancellor Rishi Sunak would be speaking with some proposals and setting out his view in a mini-type budget of some initiatives that could support the economy further through this period. And we got four main initiatives from the Chancellor yesterday, focused around job retention, focused on VAT, and then on stamp duty. And I just wanted to give some perspective on each of those. On the employment side, the job retention, or the incentive to bring workers back from furlough. So businesses will receive £1,000 for each worker they bring back over the coming months, and that will be a scheme that will pay out provided those individuals are still in employment in January of next year. We then saw support for the 16 to 24-year-old age cohort, and I think that's an important age cohort because they are the ones that are probably disproportionately impacted by the current situation. So what will we see there? We'll see the government paying for a training scheme, an apprenticeship type scheme for those in that age cohort, and that will be paid directly to the employers that take them on. And then more areas that are focused on the consumption and getting the consumer back in action effectively. So we saw a VAT cut from 20% to 5% for three sectors: hospitality, accommodation, and then the attraction sector. And that's a positive to get consumers out there given that reduction. I think the key question there, however, is do those providers of those services use that 15% reduction to reduce prices, or do they maintain prices as they are to protect their margin, I suppose also to build some financial resilience into their business model as the recovery continues to move forward. We also saw an eat out help out scheme, which for everyone to eat out in August, there's an incentive to do that. So there's something that could again support the hospitality sector in a way that is quite innovative and borrows from something that we've seen in other markets, and particularly something that was offered in China as the economy there was trying to recover. And then the final aspect is the stamp duty change, so moving stamp duty on properties from those at £125,000 to £500,000. And that, again, should be supportive of the housing market and will allow the housing market to continue to potentially recover, because that is quite a material change for that bracket and the change of tax that will be payable from a stamp duty perspective. So a number of initiatives, total cost of those approximately 30 billion. And when we take it into account as to where we are now, if we include all of the various fiscal measures that have been put in place and the loss of revenue that the government's had to suffer, it does look as if borrowing requirements for this year will be some £350 billion. Quite significant when we think about that in relation to national income. It's about 18% of national income. And also where we were in March pre-COVID, where the borrowing requirement for the government for this year was estimated to be in the region of, say, 50 to 60, 65 billion pounds. So quite a significant and material change. It shows the damage that COVID-19 has done to the economy, but also the support that the government has had to put in place to navigate our way through that. What did that mean for asset markets yesterday? Well, in the UK, we didn't actually see any significant move in terms of the FTSE 100. FTSE 100 fell about 50 basis points. Gilts were unchanged, the 10-year at about 18 basis points. And sterling actually increased yesterday and strengthened against the dollar, although I do think that's more a function of dollar weakness as opposed to overall sterling strength. Looking then at other asset markets across the globe, we saw European equity markets slightly weaker. Euro Stoxx 50 fell about 1.2% yesterday. The US, we saw a continued move forward with equity markets there. Nasdaq continues to reach a new high. Interestingly, just over the past number of days, the Nasdaq, yes, it has been hitting new highs, but the number of stocks contributing to that has been declining, and it's really the mega cap tech companies that are driving the Nasdaq to those higher levels over the recent number of days. I think that's also just an interesting point to reflect on the US, where we continue to see a rising COVID-19 case count. That's probably one of the factors that's weighing slightly on the dollar, and why we're seeing dollar weakness against its major trading partners. Then other things just to touch on, we heard from a number of the Fed regional presidents yesterday talking about the recovery in the US and just the impact that the rising case count is having on that, and specifically that it may impinge on the speed of the recovery and may challenge just the dynamics that they have been thinking about. But each of them obviously continuing to reiterate that the Fed stands ready to do what's required. That's it from me today. Thank you very much. Again, just if you could like on the YouTube channel, that would be very much appreciated. Thank you.